Welcome back to the channel, everyone. My name is Saman Habibi and I'm a real estate agent here in the Durham region. And today I'm going to be giving you a market prediction video for the year 2023. Everyone wants to know what's going on with real estate prices. Are they going to go up or come down? And everyone's trying to time the market. So we're going to dive into this topic and try and come up with some sort of solution for everyone. As you know, real estate is a very specific investment strategy for you. So as always, if you want to have a one-on-one conversation with me as to what you like to achieve and what your strategies are going forward, my calendar link is below. Feel free to book a one-on-one call with me where we can talk about your specific goals. If you enjoy watching this video, please like, subscribe, and drop a comment below with your questions and we can chat about them. So when it comes to real estate, there are several factors that have an impact on what's going on with the market. And today we're going to talk about those factors. The first thing I want to talk about is interest rates. So we know that in fiscal 2022, the Bank of Canada raised interest rates 7 times, and this had a material impact on real estate prices. So when we look at the Durham region, we know that from the peak of the market, which was Feb 2022, till now, prices have corrected around 25 to 30%. And similarly in the GTA, prices have also corrected by 15 to 20%. So this tells us that when the Bank of Canada raises interest rates, it does have a material impact on prices. So when it comes to interest rates, the Bank of Canada looks at different factors to determine whether to raise interest rates or to bring them down or to keep them flat. And some of those events that they look at is GDP, inflation, and employment. And recently we have had some data come out on these topics, and unfortunately these factors have not corrected. So we know that from a GDP perspective, our GDP has actually grown slightly month over month. Employment expectations were higher than what the expectations were. And when we look at inflation, inflation is nowhere near the 2% that the Bank of Canada would like to achieve. So this gives us an indication that going forward during the next announcement, which is January 25th, it is likely, and we can assume, that the Bank of Canada is going to increase interest rates slightly more. Now, this will set a tone as to what's going to happen in the later announcements set for 2023. But if we see an interest rate increase on January 2025, and in the following months there is no correction to GDP growth, inflation, and employment, we can expect more increases in the near future. And again, this is going to have a negative impact on prices, and as a result, bring prices down. Now, when I say negative impact, this really depends on which part of the scenario you're on. Are you a buyer or are you a seller? If you are a buyer, of course, this is an opportunity to try and get into the market, because from a down payment perspective and from a principal pay down perspective, you have a smaller amount to work with. But if you are an investor and if you're a seller and you need to get out of the market, this is going to have a negative impact on you. So the Bank of Canada is going to have 8 interest rate announcements for 2023. We're going to put the dates up here. Feel free to pause the video and put them in your calendar just so you can be up to date when these announcements come out. The second factor that I want to talk to you about is supply and demand. Now, when we look at supply and demand in Canada, it's a very complicated scenario to look at. Essentially, in Canada, our supply is very low and our demand has been always immediate and right away. And the reason as to why this is happening is because when we look at the supply side, we have a very limited amount of supply coming to market, and that's because of the scarcity of land and, of course, red tape. And when we have low supply coming to the market, as a result, there's low inventory, and if the demand's high, then prices are going to remain high. Now, there is a new bill being introduced by the provincial government called Bill 23, which is supposed to allow for more supply to come into the market, but this supply won't actually come into the market for the next 5 to 7 years. And as a result, the supply issue is still going to remain in the fact that we don't have enough supply to keep up with the demand. Now, it is important to note that this Bill 23 that was introduced is supposed to have a positive impact on supply, but there's a lot of pushback from municipalities because as part of this bill, development charges are going to be put to pause, and essentially each municipality is saying that this is not good for our business because no development charges means no revenue for the municipalities, and as a result, municipalities have to increase property taxes. We spoke about supply on the new construction side, so now let's talk about supply on the resale side. So resale would be anything that is available right away, typically a property that's been already built and being resold. Now, even on the supply side, we still have a shortage. So because we're talking about the Durham region, I can tell you that the Durham region right now has the lowest months of inventory across the GTA. The supply from December 21 to December 22, so year over year, was down 19%. So this is essentially telling us that even people who currently have inventory are not putting them on market to sell, and this could be for various different reasons. It could be that prices are lower and people don't want to take a loss, but essentially gives us an idea as to what's going on with the resale market on the supply side. And the demand story has always been the same in Canada and in the GTA for that matter, and that is immigration. We have record number of immigrants coming into the country, and the argument is that as more people come into the country, they're going to need more homes to live in, and as a result, the demand continues to be high. With that said, if we go back to the supply conversation, I expect that as we head to the spring market, we are going to see more inventory coming to market, so therefore a bit more supply available for people to choose from. And as a result, because there's more supply for people to choose from, coupled with higher interest rates, I would expect prices to come down slightly more in the spring market. The third event that I want to talk about is foreclosures. So what's going to happen in 2023? I want to break this conversation down to people who own principal residence and people who own investment properties. So on the principal residence side, I think the people who are going to be impacted the most are those who have variable mortgages. Essentially right now, those payments are going up, increasing over months. And people are either digging into their savings account to service this debt. And as a result, I think once they come to a 1 year, 12 months to 16 months of digging into savings account to service the debt, I think that's when people are going to feel the pressure and essentially have to make a decision on whether they're going to keep this property or not. And if they're not, there's going to be an influx of inventory coming to market in the form of a foreclosure sale. Now for investors, I think the narrative remains the same. I think people in trouble are the ones who are on a variable mortgage, but more so people who took out a home equity line of credit on their principal residence to use as a down payment on an investment property. So these are individuals who are highly leveraged. The home equity line of credit operates on the higher interest rate. As interest rates go up, payments on the home equity line of credit goes up, and mortgage payments on the variable mortgage continues to go up as well. So what's going to happen is that people are going to be servicing high levels of debt, and again, likely their cash flow on these properties is not going to cover them. So they're going to be going into their savings account. Now, if you have 1 or 2 or 3 properties, the multiplier effect comes into play, and now you have to service, let's say 4 or 5 properties, and you have to do that on a full year basis, which again puts pressure on people. And if you're highly leveraged with a home equity line of credit and a variable mortgage, I suspect people are going to try and hold on to this for as long as they can, and essentially by mid-year try and make a determination as to what direction the interest rates are going to move in. If interest rates are where they are now or slightly higher, I would expect to see more people in danger and more people want to put these properties for sale. And if these people are under pressure and have to bring properties to market, I think there's going to be a fire sale happening, and people who are ready will be able to buy these properties at a discount. And the last topic that I want to talk about is the loan loss provisions. So when we think about the banks and the amount of mortgage that the banks hold, this amount is fairly large. We're in the trillions of dollars. What's going to be important is looking at what the banks do with their loan loss provision. So a loan loss provision is an allowance that the bank sets aside as an expense item in order to account for uncollectible debt. So we know that our banks have a large position in mortgages that they provide to loans that they provide to homeowners. So this is an allowance that they're setting aside for people that are not going to cover this debt. And essentially this is important because at the bank level and at the top level, they have access to a lot more information that the general public does. So for example, they know how many people are in arrears, they know how many people are buying properties with home equity line of credits and what portion of the home equity line of credits are in arrears. They have data, going back to 20, 30 years during all our other financial correction times. So they're able to make a projection. And if those loan loss provisions start to increase quarter over quarter, then we know that there is people who are in very tough situations. And as a result, this could also be an indication as to properties coming to market, having to sell because owners are in a lot of pressure. So this data will be available on OSFI's website. I'll put a link in the show notes below. If you like, you can go on their website and you'll have to select a couple criteria that you want to look at, and you'll be able to follow what's going on with the loan loss provisions. All right, guys, thank you very much for watching my 2023 market prediction video. As always, if you have any questions, please drop them in the comment section below. And if you can like and subscribe to the channel, that would be greatly appreciated. And please remember that the topics discussed in this video is only for educational purposes only and should not be taken as investment advice. You should always seek the advice of a competent professional when it comes to making an investment decision.